What's good, YouTube? It's Tom the Trader and I'm back. Hope you guys are having a good day. I'm not going to waste your time. I'm going to go straight into it. Today, we're going to be talking about why the high time frame can help with your psychology. For me, psychology is everything. So if I can drop some gems about psychology that I've learned, that's a win-win, right? For me personally, when I discovered the high time frame, it changed the game completely for me. So I want to share with you some things. If you see me looking down, it's because I'm looking at my notes, so I don't miss anything. So for me, no matter what, I let the trade hit either take profit or stop loss. I mean, if you keep putting your trade to break even, you're going to lose trades that you never had to. For example, I'm sure you've taken a trade which has gone to your stop loss when you've moved it to break even, and then it quickly turned back and triggered your stop loss, and at the same time it flew straight into profit. You know, I'm sure we've all had trades like that. That could have been avoided if you just make sure you don't do break even. You just either stop loss or take profit, because more times, sometimes the trade might come, mess around your entry price and then go to your right place. But if you put a stop loss there, you're just going to exit and watch your trade go to the moon and gonna be pissed. So there's no point, you know. So we need to understand that we need to stop trying to control the markets and understand that the markets control us. I repeat, we need to stop trying to control the markets and understand that the markets control us. So let me drop some points now. For example, if you trade with the high time frame, you're more likely to hold on to your trades for longer, especially your winners, which will allow you to take profit more often. Because if your losses are the same size or bigger than your winners, you're not going to be profitable long term. So you need to make sure, please, make sure your losses are small and your winners are big. And if you keep cutting it, it's not going to get big. It's always going to be the same as your losses. So number two, you need to know that if you trade with the high time frames, like the daily and over, they're the main ocean. And trading on the smaller time frames is like jumping onto the smaller wave as it comes back to join the major wave. So you need to know that all the smaller time frames, the smaller waves, are following the major wave. The current from the major waves moves the market of the small waves. So don't get lost trying to go against the trend. Always be in the same trade, same direction as the main trade. That's it. You know, if you're trading with the high time frame, it also helps you filter only taking trades that match the high time frame trend, which allows you to cut the noise in trades that are going in the opposite direction, which is normally in the lower time frame. So you might go to the lower time frame, see a 5-minute chart going bearish, but the high time frame is bullish. Me, I'm going for the bullish, because the smaller time frames always follow the market. So it follows the high time frame markets. So we might as well go there, right? Also, all time frames need to match from top to bottom to the entry time frame. So if your entry time frame is not in sync with the rest of the high time frame, the trade is invalid and I advise you not to take the trade. Well, it's at your own risk, right? For me, if one time frame is not matching the others, to me it shows me that this trade is an 80% chance of winning. It's not a 100% chance of winning. 100% for me, even though we're not trying to predict the markets, but a very high probability trade for me is if everything is in sync and in line. Also, let's see it like this. Another analogy. The small time frame, the leader of the small time frame is the high time frame. So if they follow the leader, which is the high time frame, they're going to go in the right direction. But if one time frame, i.e. a soldier, decides to go in the opposite direction of the leader's trend, they might get killed because they decided to go in the opposite way, where right now all the soldiers, the main soldiers, the leaders are going this direction. Why are you going to go another direction where you might see some oppositions sitting there camping? They're going to get you because you're the only one there. You know, there's strength in numbers. So if you go with the major trend, you're more likely to win. You know? So then don't get caught on the 15-minute trying to go in the opposite direction of the major trend, you know. Also, going in the direction of the major trend will allow you to feel confident in your trade. It will also allow you to stop second guessing your trade. I mean, if your signal is saying going bullish, why are you thinking about it? The major time frame is saying bullish too. It's a high probability trade. You might as well take it. You know, simple as that. Also, more time from my experience. The news normally goes in the direction of the high time frame. More time that I've noticed. So if you're going in the same direction, if a news has come out, there's a high chance it's going to go in the direction of the major trend. So that's something to keep in mind. Let me drop a little something that I do in my strategy. So I normally don't trade on Mondays and Fridays. For me, Mondays is erratic. Fridays is all over the place. Last day, everyone wants to get out the trades and everything. So me, on Monday and Fridays, I only aim for 1-to-1. That's it. There's a high chance of me getting my 1-to-1 before the market does whatever. But on the other days, I'm risking 0 to whatever. 5, 0, 1 to 5, 1 to, you know, anything high, 1 to 2, that's what I'm aiming for. But on Mondays and Fridays, I'm aiming for 1-to-1. So if you like, you can adopt that. It works for me. So what's left? So if you're trading in the direction of the higher time frame, it allows you to take a break because candles are not printed so often. Once an hour, once every 4 hours. You can go and do something which allows you not to get emotional with the candles, because you sitting down watching the candles, there's some type of connection there. You might feel it. You might exit because you think it's retracing. Really, it's still going your trend, but you're feeling the candles. So it's best to, if you're someone that reacts to the movement of the candles, trade a high time frame. Take a break, go and do something. When you come back, see if you've won or lost. You know, so that's another benefit of the high time frame. You know, so yeah. Also, when you're trading the high time frame, you don't have to think as much. I mean, you got time to think. You got every hour, every 4 hours to think. But you can even be tired or even sad or anything. You can still take a decent enough trade. But if you're on a 5-minute, 15-minute, you have to be on point. You can't miss anything. You know. So that's what I would say. Just relax, guys. Choose a time frame that matches your personality. If you're someone that can handle fast markets, then trade that. If you can't handle that and it makes your heart race, check your heart rate. When you're taking a trade in a low time frame, check your heart rate. When you're taking a trade on a high time frame, check your heart rate. Are you breathing heavy? Are you feeling nervous? If you're feeling nervous, time to go to the high time frame. You know, choose your personality. Find your personality first. That's why trading is about finding yourself. Find your personality that will allow you to know what time frame you can trade. That's it, guys. A few gems here. So please like and subscribe. I mean, that's the way you're going to find out about my new videos, right? Like and subscribe. Let's connect. And I'll see you in the next video. Peace.